economists were really affected by the continued numbers on jobless claims last week, unprecedented declines in real estate as well as manufacturing. Not so impressed by the optimism that seemed to hit some markets when they're looking at a drug showing some effectiveness, as well as plans by the president to open up the economy. So the result was a lower outlook for second quarter GDP, something better of a rebound expected. Looking at the rapid update, we're now looking at a 34% decline in the second quarter. That's down a bit from what we had earlier in the month. It's not a bit, it's actually 7 percentage points, but in context, it's a bit. With a little bit more expected on the third quarter and the fourth quarter. So is this a V? Well, you look at it, you say, you know what, it takes 2-3 quarters to get back what we lost in that one quarter. So not necessarily a V here. Looking at which economists are where, 45% decline paces the street, which is Barclays' estimate, followed by a 35%. They do have a V built in at Barclays. Goldman Sachs minus 34, followed by a 19% rebound. And Citi right about with the average, also a V, but not as far down, a little bit further up. What are the constraints that economists are looking at when it comes to whether or not this third quarter and fourth quarter rebound actually happen? They're worried about businesses being shuttered much longer than is currently forecast. Consumers continuing to shun social gatherings. A second round of contagion figures in everybody's risks to their forecast. And of course, the idea that stimulus, you have this relief program now, but no stimulus on the back end. Guys, they'll be looking for whether or not states are helped and whether or not this money from small business and the Fed's Main Street lending program actually gets out to the economy to keep things from getting worse. Kelly?
Steve, do you still get the sense that people are kind of guessing on this, or how wide are we talking about in terms of a range on these forecasts?
Well, it's a guess, and it is really a forecast, and I'll tell you how that kind of works, which is they're looking at the decline, for example, the increase in jobless claims and the decline in employment. You figure that many people doing that much less work, and you can use certain formulas that exist for GDP. The guesswork comes in: how long will we be closed? How much of the economy will be closed? And geographically, what will be closed? So that's where the guesswork comes in. But what they are doing is taking certain assumptions, putting that into their model, and coming out with their forecasts.